investors and traders, and welcome to the weekly market report. I'm AJ Monty, Chief Technical Analyst with Sticky Trades, and the markets have just closed. We had a very interesting day today as the outlook for the Fed with regard to cutting rates seems to bring more optimism into the market. But as you will soon see from the data that I will provide at the end of this report, you have to be extremely careful when trying to forecast Fed cuts. And so as we look at the Dow, I added some data on this particular chart right here with that green arrow. That is what I refer to as the Jim Rohrbach method for trading the moving average. Now, hopefully you had a chance to watch my midweek report where I suggested, based on the evidence and the signals, that we could see a bounce. And for the past 3 days, that's exactly what's happened. Wednesday, Thursday, and Friday, we pivoted up. Now, we do have a higher volume day here, and the momentum is still continuing on the upside. So what is the forecast for early next week? Well, if you take a look at these highs right here, we're right at that resistance high. But we have enough momentum on the upside to keep that going for a little while. Now, here's what I'm going to do. I'm going to provide you with a contingent target based on a volume drop. So in other words, I do think that we could rally over that resistance based on the high volume. So what I'm going to do is I'm going to put a high resistance level right here, just a horizontal line right there, and I'm going to suggest that we go higher. Now, once the volume drops, right there, this is the contingency part of it. I don't do this much, but I do it quite regularly on the Wednesday report. Once we get the volume drop, I think we're going to drop right back down below that former resistance and possibly right back down to the moving average and maybe even beyond that. Another thing you have to keep an eye on is that CCI down there. It is just barely overbought, but once the volume drops, I know I'm making a lot of forecasts here, but once that volume drops, the CCI is most likely going to turn back down. Now, for those of you who subscribe to my trade publications, you'll know we took some long positions this week. So this doesn't surprise me to see this bounce. But for the longer term outlook, I am not changing those March 2020 low targets at all because the economic data is looking pretty grim. This is all short-term rally based on news and expectations of the Fed. But you have to be very careful that you're not being manipulated at all. So now looking at IWM, you can see that we did hit the downside target. This did not show an up arrow today. It was the Dow, right? There's only 30 stocks in the Dow Jones Industrials. IWM of the small caps, we didn't see a massive rally in IWM. Yes, we saw an increase in volume, but now that we've hit this downside target, I think IWM is going to continue up to that moving average. And then again, another forecast that we'll see a drop in volume. I'm going to draw that line horizontally so you could project out this way. So once that volume drops, I think the moving average is going to act as resistance, and then we'll have to see what happens on a pivot after that. Looking at QQQs, the tech sector absolutely on fire here. Gapped up. Isn't that interesting? It gapped up. Look at the volume increase here. That tells us that the bulls are still in force. But everything that I've been talking about so far with the diamonds, IWM, the Qs here as well, and most likely the spiders, we're looking for a drop in volume. The drop in volume will tell us that the buyers are getting less motivated, at which time you'll probably see short-term profit taking coming in from the short-term swing traders and even day traders. And so that is what I'm expecting. This former fan line up here is going to act as heavy resistance. We often see markets attempting to get back on trend, which is what that fan line is, but most of the time they fail miserably with what I call the kiss of death. That is, in other words, a pivot away from and down below that former trend line. So this whole area up here will be acting as resistance. All right, so your option traders are set up to have a field day here as we come into this week. Today's options expiration for the monthly options in January, and then the new February options are taking a hold as the next near-term month. Also remember that at the end of this month, on the 31st of January, we got the big bond auction, and we're going to have to see if they come in with a long tail on the bond market. That's going to be very bad news for the general markets across the board. So again, I'm giving you some insight as to what to watch out for so that you're not caught off guard. If you are expecting a pullback eventually but still hold long positions, then there you go. You're going to be able to manage risk more effectively. Okay, so again, to reiterate on the cues, we're looking for a drop in volume. We could see a little bit higher. Then once the drop in volume comes into play, I think we're coming right back down. Came very, very close to hitting that downside target we set last week at 401.89. I'm not losing sight of that. I think this is coming right back down to that moving average. So again, there's your forecast. It's really a three-parter, by the way, which no one is going to do, but I'll do it. I want to show you how to read these charts properly so that you're not guessing at which way the market's going to go. So I'll put an upside target there, 427.99. Then I think we'll see the drop in volume, at which time we could also see a pivot lower on the CCI and then lower price target on QQQ at 409.53. Now I want to spend a little time talking about the spiders here because as I mentioned in the midweek report, I thought we could go higher, see a little bit of a bounce because there was a gap below the market on the VIX. I'll get to that next. Here we have a green candle. Again, Jim Rohrbach method is to buy on a close over the 20-period moving average. You sell on the close below the 20-period moving average. And back in the day, Jim Rohrbach, you look him up, Jim Rohrbach was known to be the Zen of market timers based on that very simple concept of moving average crossover method. So we still have that green arrow. I think we could go a little bit higher on the spiders. Now I'm just going to leave it at that. Upside target on the spiders of 485.85. And with that, I'll show you why I think we could go higher, at least a little bit higher, and that's because of the VIX. Look what's happening here today, folks. We have almost a gap fill. The gap on the VIX will be filled when the market trades back down to the former high of 1308. You see that? So we came in on a low today of 1328. So we are literally 20 cents away from filling that gap. I believe that gap will fill next week. That will complete the gap fill, and then I believe the markets are going to turn from there because over 80% of the time, especially with the VIX, the reversal occurs after the gap has filled. You see, so that's why I think we could go a little bit higher because that gap is still open. So what I'm going to do is I'm going to put a gap fill target right there short term, and then once that target fills, I think we're going right back up on the VIX short term, which means that while the VIX and the S&P are for the most part inversely related, once that gap fills, we expect the VIX to go up, which puts pressure to the downside on SPY, and that is 1397. Now, before I get into the geopolitical news, let me first point out that all of my analysis is based on a 7-point trading checklist, and that exception would only be when I'm discussing pattern breakouts. So in other words, these are the 7 points that I look at with the type of candle representing price and volume being the two most important. However, when there's a pattern breakout, we tend to put less weight into the divergences from the moving averages, stochastics and CCI and other oscillators. So keep that in mind. While this works very, very well for swing traders and even shorter term traders, you have to pay very close attention to breakout patterns as well. So with that said, let's take a look at what's happening here. IMF is talking about bets on rate cuts being premature. We didn't see any of the market flinching today on this. The optimism about the Fed reducing rates is still in the market, still pumping money into the market. And that tells me that you still have to watch out because I believe the disaster is on the horizon when you have so many analysts, so many economists putting warnings out there and then seeing how the market basically is ignoring anything that's coming out by the Fed or the International Monetary Fund representatives here, you're going to eventually see a bubble that leads to disastrous moves to the downside. So just keeping this out, because most people don't want to talk about negative news. Don't get me wrong, we still take long positions, like I said, but we're very, very defensive here. Now, in addition to this, I believe, again, this is speculation based on the data that I'm pulling up, is that it's going to be in the financial sector, particularly the commercial real estate market, that we're going to see the first domino go down. This is the leveraged finance sector is continuing to deteriorate, and experts believe that this will continue throughout 2024. Now, when you couple this type of news up with what we're eventually going to see in the bond auction, this could be very, very interesting close to January 2024. So keep your eye on the headlines, but don't buy too much into the narratives that you're seeing. When I talk about manipulation, I talked about this on Wednesday as well. I try to point it out whenever I see it. So while Goldman was dumping billions of dollars of stocks, they've been telling their clients to buy. You see, this is exactly what happens. They pump and they dump. This is on a much larger scale, of course, but it happens, and here's the evidence of it right here. You can Google this, read the entire story, read the report. I hope you do, because these are just snapshots of stories that I pick up. You want to get the entire story and get it in full context. So that's out there right now. This is very, very interesting because I continue to talk about debt. We're here right now in Fort Myers, Florida, having a live event for our VIPs. One of our bond specialists had talked about debt and what's happening not just with Americans and credit card debt, but what's happening with government debt. This is getting more serious by the day, not by the week, not by the month. By the day, this is getting more serious. So there's a lot of pockets of trouble out there, and you have to understand that Americans, or I should say more Americans, are now trapped in credit card debt, and it's spiraling out of control, right? They're going month to month. Some people are actually going week to week. And it seems like the market is ignoring this. Well, guess what? The end-line consumer is what's going to drive profits for a lot of these companies, including the tech companies. So if Americans don't have the money to spend, that throws us right into the throes of a recession, which I believe is already happening. But because it's an election year, no one is going to want to use the R word. That's the death for any incumbent right now, recession. And so I think it's already here. They're just not reporting it. They're disguising it, masking it. They manipulate the numbers. The CPI is one of the most manipulated numbers. Unemployment numbers are manipulated. Keep your eye on the charts. Keep your risk management in place and keep moving on and following the money. Now, I have never heard this term before until this week. Doom spending. What the heck is doom spending? That's a phenomenon where it is basically defined as money being spent despite concerns about the economy. And this is basically a behavior that helps people cope with stress. Believe it or not, this is a real thing now. And so I dug a little bit deeper into this doom spending, and I pulled up Credit Karma report. According to Credit Karma, 96% of Americans are concerned about the current state of the economy. 96%. Now, these are the biggest and most popular credit agencies that report on this, and they get their data from the very consumer that reports debt and savings and mortgages and car loans. I think this is one of the most reliable sources for what's happening in America with regard to consumer spending. 96% of Americans are concerned about the state of the economy. Now, what happened today? Now watch the conflict here and why you have to be very, very careful about what's going on. Today, this article came out, Yahoo Finance. Consumers haven't felt this good about the economy since 2021. December was no fluke. Look, quote unquote, December was no fluke. And boy, they pumped this story all over the airwaves while the Bulls were running in. Take a break, take a step back, look at reality. 96% of Americans are concerned about the state of the economy. And then all of a sudden, in one day, we have consumers are feeling so good about the economy. And we haven't seen this since the end of the pandemic. Folks, use your gifts of discernment. Read the news. determine what's truth, what's fiction, what's lies, right? Factor that into your decisions as you are getting in and out of the market, and make sure you're not fooled or become one of the sheep that ultimately take the big hit. Now, this final slide right here, again, I got to talk about the yield curve. This is the longest curve inversion ever. And it does not look like that curve is going to get back to flat anytime soon. When you have an inverted yield curve, that is one of the most reliable, if not the most reliable indication for recession. There hasn't been a time where the yield curve has remained this inverted without a recession. So it's not a question of whether or not we're going to have a recession. The question now becomes, how bad is this recession going to be? Well, folks, be sure to tune in to stickytrades.com. There's a lot of good info coming out. Please like and share our videos. You're doing us such a great favor. We pick up new subscribers every week, and that's thanks to you. When you like and add comments and you subscribe, our program gets added to the main menu on YouTube, and more people pick it up from there. Again, thanks to you. So you have a great weekend, and we'll talk to you on the next video. So long.